I'm in San Antonio for NAREIT's REITwise, our 2019 Law, Accounting, and Finance Conference. Joining me today is Adam Feuerstein, National Real Estate Tax Technical Leader with PwC. Adam, thanks so much for joining us.
No, thanks for having me.
Now here at REITwise, you were on a panel focused on emerging tax issues for REITs. What do you see as the main issue REIT tax directors need to focus on?
Well, there's so many with tax reform, it's sort of hard to pick one, but I'd say probably the interest deductibility limits under 163J, in part because the rules are complicated, in part because we just have proposed regulations right now. There are lots of issues with them, and so people are a little bit on a moving playing field, not exactly sure what the rules are going to be when final regulations come out. And then also, and this is particularly an issue for REITs that have debt at partnerships, and especially when there are partnerships below those partnerships, because those partnerships may be taking different positions than the REIT might want them to take, or you have different advisors who are taking different positions. So again, it's just one of those things to keep track of. Again, a complicated set of rules, moving playing field, maybe some different views about how the rules should be interpreted, and so that's making it a little bit more challenging this year than maybe in prior years.
And what are the practical uses of REIT savings clauses?
So REIT savings clauses, just taking a step back, I tend to think of those as provisions in the code that REITs can use when they have a technical violation. So a REIT violates the income test or the asset test. Technically, it doesn't have the right amount of income or assets, or another violation. And there's a provision in the code that says you can still qualify as a REIT, you just need to satisfy these other requirements. You won't lose your status, maybe you have to pay a fine, maybe you have to do some filings, maybe you have to have had reasonable cause. There are certain different rules for different savings clauses, but that's basically what a savings clause is. And one, it can give a REIT comfort that even if it has a technical violation of one of the tests, it might still be able to qualify if it meets these other rules. It can give an attorney perhaps comfort in giving an opinion about the REIT, even though it knows it violated one of the what I'll call the initial rules to qualify as a REIT, because it satisfies the savings clause. Auditors might rely on that in order to not put a reserve on financial statements with respect to REIT status. And so again, all sorts of ways that it can be used. One of the key uncertainties is with respect to reasonable cause, because that's often one of the requirements to utilize a savings clause. And it's not quite clear exactly when one satisfies a reasonable cause. So the goal is to not have to rely on a savings provision, because it is probably an area of uncertainty once you fall there. But it does provide a backstop that can be very helpful.
And lastly, what are the biggest open issues that REITs face in implementing the Section 199A 20% deduction rules?
Well, fortunately for REITs, it's relatively easy. It's the partnerships below the REITs where they really have to think about it, because the REIT dividends that are ordinary dividends generally are eligible, no questions asked. But once you have a partnership in your structure, whether it's an operating partnership or joint ventures that might be directly held by the REIT or below the operating partnership, there's a whole host of things that people have to be thinking about. A lot of the more difficult issues were addressed in the final regulations, which is helpful, but people still have to think about what are my separate businesses, how do I aggregate those businesses, am I even in a business in the first place once you sort of separate out your activities, are you doing triple net leases, which can raise some issues, so all sorts of questions about qualification. And then even if you realize that you're qualified and eligible to take the 20% deduction, or your partners would be eligible, there are all sorts of record keeping that you have to be able to do. You have to keep track of W-2 wages on a business by business basis, and then you also have to keep track of your unadjusted basis. And that's a new calculation that people have to get their arms around. It got much simpler, I think, with the final regulations, but still a new calculation, and people who are at REITs and who are in charge of tax have to be focusing on that, making sure that they're collecting the relevant information to be able to report it out to partners.
Okay. Adam, thank you so much for joining us.
Thanks again for having me.
For more information on this and other REIT news and analysis, be sure to visit NAREIT's website, REIT.com.